Chaotic stock markets, sky-high interest rates, and the pain of inflation have left one question at the top of Americans' minds. Are we in a recession? Probably not yet, but there are signs of economic weakness emerging. When that will turn into a prolonged slump and how long that downturn might last are important questions preoccupying people on and off Wall Street. Technically, the country is in a recession when gross domestic product, the value of all goods and services produced during a specific period, falls during 2 quarters back to back. In the first 3 months of 2022, the U.S. GDP dropped by 1.4%. Major banks have upgraded their forecasts to reflect the increasing possibility of an economic downturn. Analysts at Goldman Sachs put the probability of a recession over the next year at 30%, up from 15%. Economists at Bank of America predicted a 40% chance of a recession in 2023. In this video, we are going to talk about what a recession really is, and should you be worried when it hits? What would be the measures to counter the tough times, and most importantly, what leads to recession? Before we start, be sure to hit that like button, subscribe, and hit the notification bell so you never miss a video. Without further ado, simply put, a recession is when the economy stops growing and starts shrinking. Some say that happens when the value of goods and services produced in a country, known as the gross domestic product, the GDP, declines for 2 consecutive quarters, or half a year. Recessions come in all shapes and sizes. Some are long and some are short. Some create lasting damage, while some are, the short answer, the Federal Reserve. What is perhaps most startling to Wall Street is how quickly everything changed. The first signal came on January 5th, when a readout of a Fed meeting that took place at the end of last year was released. Those minutes showed how Fed members saw rising inflation as a major risk to the economy, and they would have to start raising rates sooner than expected. The words were dry, as they often are, but the summary signaled a dramatic negative shift in the Fed's stance. The reaction in the markets was swift. All the major stock market indexes fell that day, with the Nasdaq dropping the most, over 3%. From there, it only gets worse. Fed officials continued to affirm their negative stance over the next few weeks and months. The inflation numbers got worse, and that combination sent a spiral of pessimism through the markets. To combat inflation, which is running at a 40-year high, the Fed has acted aggressively. They raised the benchmark interest rate 3 times so far this year, including once earlier this month by 0.75 percentage point, the biggest hike since 1994. One of the chief investment strategists at BMO Wealth Management, Young-Yu Ma, said that it has been a very fast-moving environment where inflation continued to surprise to the upside, and the Fed's own projections of how quickly they were going to raise interest rates kept surpassing expectations. The central bank is trying to slow the economy down in order to curb inflation, which is now rising at its fastest pace since 1981. Last week, the Fed's announced its biggest interest rate increase since 1994, and more big jumps in borrowing costs are likely this year. The Fed is trying to rip the Band-Aid off, said Beth Ann Bovino, the chief U.S. economist at S&P Global, by raising interest rates quickly. The Fed is saying, we've got to move now. We've got to move hard, and we have to front-load a lot of rate hikes before the situation spirals out of control even more. Stock investors are worried that the central bank will wind up slowing growth too much, setting off a recession. And the S&P 500 is already in a bear market, the term for when stocks fall more than 20% from recent peaks. In a housing market where mortgage rates have jumped to their highest level since 2008, real estate companies like Redfin and Compass are laying off employees in anticipation of a downturn. Consumers, the economic engine in the United States, are also growing worried about the economy, and that's a bad development. In May, consumer sentiment reached its lowest point in nearly 11 years. The way households prepare for a recession is to save. The downside is, if everybody saves, then the economy doesn't grow. None of this means that a recession will begin for sure. It's important to keep in mind that the job market is still strong, an important pillar of the economy. About 390,000 new jobs were created in May, the 17th straight monthly gain, and the unemployment rate is close to a half-century low at 3.6%. Continues to raise rates to try to clamp down on inflation, we'll see an even greater increase in borrowing costs for mortgages, car loans, and business loans, for example. So even if you qualify for a loan or credit card, the interest rate will be higher than it was in the prior year, making it harder for households to borrow or pay off debt. We're already seeing this in the housing market, where the average rate on a 30-year fixed mortgage was recently approaching near 6%, the highest level since 2009. During recessions, as rates go up and inflation cools, prices on goods and services fall, and our personal savings rates could increase. But that all depends on the labor market and wages. We may also see an uptick in entrepreneurship, as we saw in 2009 with the Great Recession, as the newly unemployed often seek ways to turn a small business idea in the Great Recession. Unemployment peaked at 10%, and it took an average of 8 to 9 months for those out of work to secure a new job. So now could be the time to review your emergency fund if you think there's a shortfall. If you're not able to cover a minimum of 6 to 9 months worth of expenses, see if you can accelerate savings by cutting back on spending or generating extra money. It's also a good time to make sure your resume is up to date and to establish contact with influential individuals in your professional and personal network. If you are laid off, make sure to apply for unemployment benefits right away and secure your health insurance. If you're self-employed and worried about a possible downturn in your industry or a loss of clients, explore new revenue streams. Aim to bulk up your cash reserves as well. Again, if previous recessions taught us anything, is that having cash unlocks choices and leads to more control in it. Wall Street is having a hard time adjusting to a new reality. With the Federal Reserve aggressively hiking interest rates to fight high inflation, the economic landscape has changed dramatically. At the halfway point of the year, the tech-heavy NASDAQ has fallen by 30%, and the broad-based S&P 500 is down by over 20%. Both indexes are in bear-marked territory, and the Dow Jones Industrial Average is in a correction. Year to date, it is down over 15%. Basically, when interest rates go up, it changes the math of buying a car, buying a house, buying a bond, and it changes the value particularly of tech stocks, whose earnings are far off in the future. And that means that all that whipsawing on Wall Street over the past few months, including the massive single-day swings of more than 1,000 points, reflects real nervousness among investors. They're worried the Fed may tip the U.S. economy into a recession. While that volatility has been driven mainly by rising interest rates and inflation, it has been compounded by numerous geopolitical risks. COVID-19 continues to wreak havoc, and lockdowns in China, global supply chains remain clogged, and Russia's invasion of Ukraine. Historically, when interest rates rise and borrowing costs go up, investors pull out money from the riskier parts of the economy. High-growth companies and tech stocks are the first to see their stocks fall. This time is no different. The S&P 500's worst stock performer to date is Netflix, which is down 70%. It's an incredible reversal for a company that saw its share price skyrocket during the pandemic, when the streaming service became a lifeline for the locked down. The second worst performer is Etsy, the online marketplace for arts and crafts, which is down almost 65%. Bright spot in stocks has been energy. Russia's invasion of Ukraine drove oil and natural gas prices higher, and gasoline and diesel prices have set new records. That rise in commodities prices has benefited global energy giants. Many of them raked in record profits. So far, the best performer on the S&P 500 this year has been Occidental Petroleum, which has almost doubled in price. Valero Energy returned around 40%, and ExxonMobil, Hess, and Halliburton are also winners. Those expectations were also dramatically different from last year, when both Fed Chair Jerome Powell and Treasury Secretary Janet Yellen seemed confident inflation was going to fade, that it would be a short-lived consequence of the U.S. emerging from the darkest days of the pandemic. Now we know that they were both underestimating the path of inflation and were slow to act. A few weeks ago, Yellen admitted she had misread the moment. "I think I was wrong then about the path that inflation would take," she told CNN. This year's dramatic rate increases are a reflection of the Fed playing catch-up, but some fear that it also signals the start of a new era of higher interest rates after over a decade of easy monetary policy. Some believe that it will be necessary to deal with higher inflation going forward too. Inflation is going to be higher for a longer period of time, says Gargi Chowdhury, head of iShares investment strategy at BlackRock. Maybe not today's 8.6%, but still much higher than the pre-pandemic level. She is not among a growing number of portfolio managers who think we will see a recession in the next 6 months. Like everyone else, she is paying close attention to economic data. That includes reports on jobs and inflation from the federal government, but also quarterly earnings from companies. Whether your hours have back, you've lost your job, your business isn't making any money, or you've made some poor financial decisions, emergency savings will give you a safety net to fall back on so you can ride the wave and emerge from the recession back on your feet. If it's possible, try to save about 3 to 6 months' worth of your wages, so when the economy is down and money is tight, you don't have to turn to credit. Using credit as a safety net is a mistake that often haunts people for years. Most don't foresee the reality that they will need a larger income than they currently have to repay the money that they borrowed. During a recession, it can be difficult to cover day-to-day expenses, let alone debt repayments, and this can cause your debt to spiral out of control. Carrying high levels of debt is very risky because a slight change in external factors could affect your ability to pay your debt. Although you may be able to manage payments now, a job loss or an interest rate hike combined with banks tightening credit limits could change that. Most of us are familiar with the saying, "Don't put all your eggs in one basket," and this adage could be applied to your source of income. Having multiple streams of income can really help. If one income source starts to dwindle or gets eliminated completely, you have other sources to fall back on to help keep you afloat. Diversifying your income doesn't necessarily mean getting a second job. You can look into many different options, such as renting out a room in your home, renting out a space in your garage, or going so far as to buy a revenue property to rent out. Diversification, you can park your money in a number of different investment vehicles. Real estate is a common investment that generally appreciates with time. Investing in stocks, especially the S&P 500, is a good way to help your portfolio grow, while bonds have often been a good way to bring in income. You can also consider international investments, as diversifying into other countries can also help to reduce your vulnerability to an economic downturn. A recession doesn't necessarily mean we are looking at doom and gloom. A recession, depending on how you define it, is typically just a slowed down economy. It's not the end of the world. Investing in strong companies always wins out in the long run despite recessions. That wraps up the video. I hope you enjoyed it, and if you did, make sure to give it a thumbs up. Subscribe to our channel and don't forget to press the bell icon to stay notified about our uploads. Until next time, traders.